Hello and welcome back to the channel. So today I wanted to go over something that I think is a bit more important than what stock is the next stock to get into and get a multi-bagger return. It's actually managing your emotions when investing in equities. Now it's very easy to get emotionally invested into a stock that you're buying into. Sentiment is what drives the market to be irrationally exuberant or very pessimistic. The way to do well in the market is to be able to separate your logical and your rational thinking from your emotionally driven thinking. And the reason for this is also quite simple. Every day we read the same headlines, we're exposed to the same news articles, and we hear the same information about whatever company that we're following. And the majority of the market reacts in a certain way, and you are bound to feel the same way, since most people in the market have a similar sort of emotional wiring when dealing with the stock market. And it absolutely does totally make sense, since it's hard-earned money that you've put into the market, and to see it fluctuate the way it does, it's not easy. Now, before actually getting into this, I want to firstly speak to those that are new to investing or are thinking about starting. Before you get into using real money, try using a virtual account. Use an amount that you feel you could reasonably put in without losing sleep at night. For example, if you know you can only put in $1,000 at first, then don't trade with 100,000. Trade or invest with 1,000. Assess how you feel watching those positions that you've invested in go up and down. You really don't know if you've got the stomach to handle volatility until you practically go through it yourself. Do this for a couple of months or until you feel like you're ready to step up, and then use real money. Realize that trading or investing, whatever it may be, it's a marathon, it's not a sprint. And don't be in a rush to get into the markets just because you see your friends doing it and getting into it. Don't let FOMO get you. Okay, so I'm going to go over how I deal with emotion when it comes to investing, and then also when it comes to trading. Now, if you're interested in why I choose to trade while primarily focusing on value investing, I've put up another video previously titled My Approach to Buying Stocks. I'll add a link in the description below if you want to watch that after this video. Now, when investing, I tend to lean a bit more towards value investing. And the core of this ideology is drowning out the noise of the rest of the market and taking a contrarian position with conviction. Now, this conviction can only come from knowing and understanding what exactly you're invested in. If you understand something, you can approach it with a rational mindset. Let me give you an example to elaborate on this. If you've been subscribed to my channel, you've seen that I've put up quite a few GameStop videos. So when I first started buying into GameStop, this stock was around roughly in like the mid $4 range, around $4.5 to $4.8. Soon after, it went into the mid $5 range, and it almost at $6 at one point. But I knew none of this mattered, because my goal was not to gain 20% on the stock. It was to benefit from the catalysts that GameStop will experience in the coming months. Sure enough, soon after, the stock went and fell below $4. Now, if I had no clue about why I was investing in this company, then I would have said, you know what, I'm down 20%, this entire thing is stupid, and I'm just selling out. But I didn't let emotion get in the way. Instead, what I did was I added to my existing position to lower the cost basis. And I did this with the expectation that this company would do well in the coming months of, now it's September, so October, November, and December, as the new gaming consoles were released and the short squeeze would take place. Now, I'm not going to go into GameStop further. If you're interested in that, you could always check out the other video which I've put up earlier. And the title of the video, that other video is GameStop undervalued? But the point is that the stock being up or down really didn't make me feel happy or sad, since I was approaching the investment with a clear set of probabilities that I thought would play out for GameStop in the upcoming months. Now, clearly, if you understand what you've bought has an underlying margin of safety, and you were able to get in at a price below what you presume is the intrinsic value, then each time it drops in price, it would make sense for you to either lower your cost basis or just hold the position. It also helps to assign probabilities to future outcomes because it helps ground your idea in reality. And that anchoring, it really helps deal with uncertainty that's inherently present in the stock market. So basically, in summary, do your research, know what companies you're buying, and then you can allow your rationality to trump your emotions and the rest of the market participants, which may be experiencing a lot of sentiment by just looking at how the stock price is doing. I wanted to include a small clip of Peter Lynch discussing another stock that reiterates the same concept. After this clip, I'll be talking about managing your emotions while trading.
Is a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100. People said, "Here's this great company, great record. If it ever gets below 100, just buy every share." And it did get below 100. A lot of people bought on that basis, saying, "Look, it's gone from 135 to 100. It's now 95. What a buy!" Within a year, it was 18. And this is a company with no debt. I mean, this is a company. It was just so overpriced. It went down. I did the same thing in my, I think my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, "How much lower can it go?" It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, "It's gone from 26 to 16. How much lower can it go?" Well, at 10, I called my mother and said, "Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now unfortunately, this happened rapidly, or I would probably be still caddying or working at the Stop and Shop, but it happened fast. So I was able to, it was compressed. And at 3, I figured out, there's something very wrong here, because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. But they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, "There's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, "Everything's fine, and eventually this will work out." And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out their public shares in Kaiser Steel, they sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you were just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do? Psychiatrists haven't worked so far. I've never seen them running in. The Psychological Psychiatry Fund, I've never seen listed for with the SEC to make it through as a mutual fund. So they haven't seemed to help. I've tried prayer. That hasn't worked. So if you don't understand the company, you have this problem when they go down. Eventually, they always come back. This one doesn't work either. People think RCA just about got back to its 1929 high when General Electric took it over. A lot of double nits never came back. Remember those beauties? Floppy disks, Western Union. The list goes on and on. People saying it'll come back. Well, it doesn't have to come back. Here's another one you hear all the time. It's $3. How much can I lose? I've had people call me up saying, "I'm thinking of buying this stock at 3. How much can I lose?" Well, again, you may need a piece of paper for this, but if you put if you put $20,000 in a stock at 50, or your neighbor put $20,000 at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money, everything. And people say it's 3. How much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7. They'd like to short it at 16 or 22, but they figured out at 7 that this company is going to go to 0. They just haven't blown taps on this thing yet. It's going to 0. And they're selling it short at 7, they're selling it short at 6, at 5, at 4, at 3, at 2, at 1 1/4. And you know to sell something short, you need a buyer. Somebody has to buy the damn thing. And you wonder, who's buying this thing? It's these people saying it's 3. How much lower can it go?
So when it comes to trading, the advice is slightly different, as the approach is different due to the presence of technical factors in play. Whatever strategy you're using when trading, You just have to make sure that you're able to cut your losses when necessary and manage your risk. The reason why algorithms and artificial intelligence has done so well in high-frequency trading is that there is no emotion involved. It's just execution based on models. Now, this is just my opinion, but you're more likely to be successful as a trader if your approach is purely quantitative. It cuts out all the emotion from trading, and that does give you a higher probability to consistently achieve, good, stable returns. The fact is that trading requires discipline, while investing requires patience. But they both require you to know what you're doing, so the volatility doesn't adversely impact you and take away your peace of mind. Once volatility doesn't affect you as much, you'll find yourself not needing to check on what the market is doing, say, like every hour. In fact, many value investors don't even feel the need to check their portfolio for like weeks at a time. I'm not there yet, but hopefully I will be one day. It really helps to detach yourself from the market because, as Charlie Munger once said, the big money is not made in buying or in selling. It's made in waiting. Try doing, yoga, try doing meditation, or even taking care of plants. Whatever helps you emotionally and mentally refresh yourself. I hope this video was helpful to giving you an idea as to how to manage emotions when dealing with equities. If there's anything that you really liked, or if there's something that you completely disagreed with, let me know in the comments below. It would be interesting to get, your perspective on this. Do hit like and subscribe because that always helps out the channel. And as always, thank you for watching.